Welcome back to XRP Pro Ledger. While retail is staring at red candles, a single number just hit the institutional market that changes everything. Bitwise's XRP ETF recorded $426 million in inflows in a single trading day. Not a week, not a month, a single day. This pushed total XRP ETF assets past the $1.08 billion threshold in one session. If you think the smart money is waiting, you are dead wrong. They are not just entering, they are taking over. Here is the data they don't want you to process. We need to address something directly before we get into the data, because a single number landed in the institutional market today that changes the analytical framing of everything that follows it, and most retail investors have not processed its full implications. Bitwise's XRP ETF recorded $426 million in inflows in a single trading day, not a week, not a month, a single day, pushing total XRP ETF assets under management across all 7 US spot products past the $1.08 billion threshold in one session. To put that single-day figure in context, $426 million in one day represents more institutional capital deployed into XRP ETF products in a single session than most digital assets attract in an entire quarter. And the critical analytical insight is not the size of the number itself, it is what the number represents about the stage of institutional adoption we are currently in. The institutions that have been building positions through systematic weekly inflows are not the same institutions that generate a $426 million single-day deployment. Single-day flows of that magnitude come from allocation decisions that have been in institutional pipeline processes for weeks or months, and that cleared their final compliance and investment committee approvals simultaneously, creating a concentrated execution event. Stay with this analysis through to the end, because I am going to walk through the rare technical bull switch signal that has appeared only 3 times in 13 years of XRP's trading history, and explain precisely what the previous 2 appearances produced in terms of directional price movement. Let us establish the precise context for the $1.08 billion ETF AUM milestone before we address the May 1st catalyst, because the milestone itself carries specific institutional implications that extend beyond the dollar figure. When a regulated financial product category crosses the $1 billion AUM threshold, it enters a different tier of institutional visibility and accessibility. Index providers, institutional research platforms, and asset allocation frameworks that apply minimum AUM thresholds for product inclusion automatically update their eligibility assessments when a product crosses this threshold. The practical consequence is that XRP ETF products are now technically eligible for inclusion in digital asset allocation frameworks that previously excluded them on size grounds. Frameworks maintained by the very institutional allocators who represent the 65% of the institutional market that has not yet entered XRP positions at meaningful scale. The $1.08 billion is not just a milestone in the sense of a number being crossed, it is a threshold that activates a new category of institutional product evaluation and a new set of allocation framework eligibility criteria that the sub-billion AUM level did not meet. The $426 million single-day Bitwise inflow that pushed the total past this threshold was not a coincidence of timing, it was institutional capital that understood the AUM threshold's significance and provided the capital required to cross it in a single concentrated session. The May 1st Coinbase trade at settlement implementation for XRP is the structural market access event that completes the institutional infrastructure picture that the $1.08 billion AUM milestone represents from the capital allocation side. When Coinbase places XRP in the same task execution framework as Bitcoin, Ethereum, gold, and crude oil on May 1st, 2026, the operational consequence is that every hedge fund, every algorithmic trading desk, and every institutional asset manager that uses Coinbase's institutional execution infrastructure for their Bitcoin and gold futures trading now has the same execution quality available for XRP positions. This is not a technology upgrade in the conventional sense, it is a legal and operational reclassification, because the task framework that applies to gold and crude oil is a commodity futures execution mechanism. Placing XRP in that framework is Coinbase's institutional infrastructure making a functional statement about XRP's asset class status that is independent of and complementary to any legislative determination by the Clarity Act. The institutions that have been waiting for XRP to be operationally accessible through the same execution mechanisms they use for their commodity positions now have that accessibility going live in 4 days. The $426 million single-day inflow today may reflect, at least in part, the final pre-May 1st positioning by institutions whose trading mandates are triggered by the task framework going live. I want to address the retail wallet distribution data with the analytical precision it requires, because the statistics about XRP's current holder base contain the most important forward-looking signal about the scale of institutional capital that has not yet entered. And that signal is being systematically underappreciated in most retail commentary. Out of 7.8 million XRP wallets, 82% hold 500 XRP or less. At current prices in the $1.43 to $1.46 range, 500 XRP represents approximately $715 in dollar-denominated value, a position size that is consistent with individual retail investors rather than institutional capital deployment. The analytical conclusion from this distribution is not that XRP has a large and loyal retail holder base, though it does. The conclusion is that the vast majority of XRP's current price support, estimated at 40 to 60% of the structural floor, is being provided by retail holders whose aggregate position sizes are measured in hundreds to low thousands of dollars. The institutions that generate single-day inflows of $426 million, that deploy through regulated ETF products, and that build positions measured in hundreds of millions of XRP have barely begun their accumulation relative to the allocation sizes that their investment mandates will eventually authorize. The 65% of institutional capital that has not yet meaningfully entered XRP is not absent because of skepticism. It is absent because of compliance barriers, mandate limitations, and execution infrastructure constraints that are being systematically removed by the $1.08 billion AUM milestone, by the May 1st task framework, and by the Clarity Act's approaching end of May timeline. Stay tuned, because the specific mechanics of what happens to XRP's price when that 65% begins deploying into a market where 82% of wallet holders have less than $715 in exposure is the mathematical exercise that produces the price targets that institutional analysts are modeling right now. The Senator Tillis political standoff over ethics provisions in the Clarity Act deserves a precise analytical treatment, because the retail reaction to political friction in legislative processes tends toward either excessive pessimism or excessive dismissal. And neither response reflects a sophisticated understanding of how contested financial legislation actually advances through the U.S. Senate. Senator Tillis objecting to ethics provisions does not fundamentally alter the bill's legislative trajectory, because experts have confirmed that the Clarity Act can achieve passage without his support through alternative vote pathway structures. But the Tillis standoff does create is the specific political dynamic that Brad Garlinghouse described at the Semaphore Summit as peak frustration. The condition that, in every significant piece of contested financial legislation in recent memory, immediately precedes the compromises that enable final passage. Tillis's specific objection to ethics provisions is not an objection to XRP's commodity classification, not an objection to the regulatory framework for digital asset markets, and not an objection to the fundamental policy architecture of the bill. It is a procedural and political disagreement about one component of the legislation, the kind of disagreement that legislative negotiation is specifically designed to resolve through compromise, language that addresses the objecting party's concern without altering the bill's core provisions. The May timeline that Garlinghouse confirmed remains intact, and the political friction that Tillis is creating is more accurately characterized as the final negotiating friction before resolution than as a structural barrier to passage. The XRP Las Vegas conference, running from April 30th through May 1st, is the event context that connects the legislative, technical, and price action developments we have covered into a single high-stakes moment. Creating analytical clarity about what Brad Garlinghouse and David Schwartz might communicate from that stage requires understanding what institutional-level conference appearances by senior executives of a company at this stage of its regulatory and market development typically signal. Garlinghouse and Schwartz are not appearing at XRP Las Vegas to recite publicly available information. Executive appearances at major community conferences at moments of institutional inflection, when the ETF AUM has just crossed $1.08 billion, when the task framework goes live on May 1st, when the Clarity Act is in its peak frustration final negotiation phase, when a rare bull switch technical signal has just printed, are typically the moments when executives choose to communicate information that they have been permitted to disclose and that they assess will be most impactful when delivered directly to the most engaged segment of their assets holder community. I am not suggesting that Garlinghouse or Schwartz will announce specific partnership agreements or legislative outcomes from the Vegas state. I am suggesting that the timing of this conference relative to the convergence of catalysts we have documented makes it the highest probability venue for material public communications that the market has not yet priced in. The rare bull switch technical signal that has appeared for only the third time in XRP's 13-year trading history is the technical dimension of this analysis that deserves the most careful and precise engagement. Because signals with a 3-occurrence sample size over 13 years require a disciplined treatment that neither dismisses their rarity nor overstates their predictive certainty. A specific technical formation that institutional analysts are characterizing as a bull switch is a confluence of momentum, volume, and moving average conditions that historically marks the transition from an extended accumulation phase into an active price discovery phase. The two previous appearances of this formation in XRP's trading history both preceded the most significant directional price movements in the asset's history, movements whose magnitude and velocity were not anticipated by the conventional technical indicators that retail traders monitor in their daily analysis. The current appearance of this formation is occurring at a moment where the fundamental supply-demand structure is more institutionally constructed than at any previous point in XRP's history. ETF AUM at $1.08 billion, task framework going live in 4 days, Clarity Act in final negotiation, 94.4% of exchange outflows driven by whale tier accumulation, and 82% of wallet holders with positions under $715. The technical signal is telling you that the accumulation phase is transitioning. The fundamental data is telling you why that transition is occurring. When technical and fundamental analysis reach the same directional conclusion simultaneously, the confidence level of the combined signal is categorically higher than either analysis produces independently. The institutional thinking framework that most retail investors do not apply to their XRP positions is the specific analytical gap that produces the behavioral error of selling at $5 to $10, while institutional capital is simultaneously deploying at those price levels. Understanding how institutions think about position sizing, entry, and exit in an asset like XRP requires understanding that institutional capital operates on multi-year investment theses with return targets that are calibrated to the asset's long-term fundamental value rather than to short-term price levels that feel psychologically satisfying to capture. An institutional allocator that has built an XRP position based on the Gates Foundation Mohaluk deployment, the Enbridge Sovereign CBDC interoperability thesis, the Clarity Act commodity classification unlock, and the Standard Chartered $8 to $10 price model is not going to sell that position at $5 because the daily candle looks extended. They are going to hold through the price levels that retail investors consider targets and continue holding through the price levels that the fundamental thesis supports at full institutional deployment scale. The retail investors who sell at $5 to $10 are providing the liquidity that allows the 65% of institutional capital that has not yet meaningfully entered to build positions at those price levels. The same dynamic that produced the $426 million single-day inflow at current prices while retail was watching red candles and panicking over whale transfers. The mathematical picture that emerges when you apply Standard Chartered's capital flow framework to the specific institutional infrastructure developments documented today produces price implications that are worth stating precisely. The $1.08 billion in current ETF AUM represents the institutional capital that has entered XRP products before the May 1st task framework, before the Clarity Act passage, and before the 65% of institutional capital that has not yet meaningfully entered begins deploying. Standard Chartered's $8 end of 2026 target is conditional on $4 billion to $8 billion in post-Clarity Act inflows and to a supply structure that has already been compressed by systematic whale accumulation and ETF custody growth. The $426 million single-day Bitwise inflow today suggests that when institutional allocation constraints are removed, whether by AUM threshold crossings, task framework availability, or Clarity Act passage, the pace of institutional capital deployment can exceed the rate that the supply structure can absorb without significant price adjustment. The mathematical implication is that the supply compression that has been building through systematic exchange outflows, ETF custody accumulation, and whale cold wallet positioning will produce a nonlinear price response when the institutional demand acceleration that May's catalysts enable arrives in a market where 82% of wallet holders have positions under $715 and where the available liquid supply has been systematically reduced to institutional accumulation levels that the current price cannot sustain at full institutional deployment scale. The complete picture that April 28th's convergence of institutional, technical, political, and event-driven data produces is one of a market that is transitioning from the accumulation phase to the demand acceleration phase at a speed that the current price level has not yet reflected. The $426 million single-day Bitwise inflow pushing ETF AUM past $1.08 billion signals that institutional accumulation is reaching its concentrated execution phase. The May 1st Hackers framework removes the execution quality barrier for hedge fund and institutional trading desk XRP positions. The Clarity Act's end of May timeline, confirmed by Garlinghouse at the world's most sophisticated financial summit, represents the legislative event that unlocks the 65% of institutional capital that compliance barriers have been holding back. The rare bull switch technical signal that has appeared only 3 times in 13 years suggests the accumulation phase is transitioning to price discovery. The XRP Las Vegas conference on April 30th and May 1st provides the stage from which Garlinghouse and Schwartz may communicate material information to the most engaged segment of the holder community. At the precise moment, all of these catalysts are converging, and the 82% of wallet holders with positions under $715 quantifies exactly how much retail capital is providing the price floor that institutional capital, with its $426 million single-day deployment capacity, will step in to replace when retail finally sells at the price levels they consider targets. The window between now and May is not measured in hope, it is measured in documented institutional infrastructure, confirmed legislative timelines, and rare technical formations that 13 years of XRP trading history says deserves your full analytical attention. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.